Hey everyone, welcome to Talk Tickers. Today, we're diving into Argan Incorporated's Q2 earnings report. The company just dropped some absolutely spectacular results, but the market's reaction? Well, that was a total head scratcher. We're going to figure out what's going on.
And this is the big question, right? Argan delivered record profits and a record project backlog, two huge green flags. And yet, the stock got hammered in after-hours trading. So what gives? What did the market see that completely overshadowed these incredible results? Let's get into it.
All right, here's how we'll break it down. We'll start with that paradox, then we'll crunch the numbers. After that, we'll look at management's side of the story, see why the market wasn't buying it, and then I'll give you our final take in the next call.
All right, first up, let's tackle this paradox head on. Seriously, this is a tale of two completely different market reactions, all happening within just a few hours of each other.
I mean, look at this. The contrast is just night and day. On September 4th, the stock closed up almost 5%. The market was clearly feeling optimistic. But the second those numbers hit the wire, boom, the sentiment just completely flipped and the stock tanked 7.5%. This is the disconnect we're here to figure out.
Okay, to really get to the bottom of that drop, we've got to look at the numbers. Let's deconstruct the quarter and see what the data is actually telling us.
And right here, this is really the heart of the matter. On one hand, you've got this huge earnings beat. EPS came in at $2.50, absolutely crushing the $1.99 estimate from analysts. But on the other hand, a slight miss on revenue. And believe me, that revenue number is what the market latched onto. But when you look at profitability, the story gets a whole lot better. Gross margins exploded by 490 basis points. That's almost a full 5% jump year over year. And this wasn't just some accident. It was all about fantastic execution in their main power industry business. And this is the real star of the show, at least from management's point of view, a record-breaking $2 billion project backlog. I mean, that is a massive number, way up from $1.36 billion just 6 months ago. What this means is they have a ton of future revenue already locked in, giving them this incredible visibility for years to come. And if that wasn't enough, check out their balance sheet. It's an absolute fortress. They're sitting on over $572 million in cash and investments with, get this, zero debt. That kind of financial muscle gives them so much flexibility. It's a huge advantage. So you see numbers like that, and it's absolutely no surprise that management was painting a super bullish picture on the call. Let's hear their side of the story and why they think the future's so bright. A huge piece of their argument comes down to what's in that backlog. It's not just big, it's really well balanced. You've got 61% in natural gas for grid stability and another 29% in renewables. They're playing both sides, calling themselves energy agnostic, which honestly is a pretty smart place to be right now. And they're not just waiting for business to come to them. They see these massive trends driving demand. Their CEO, David Watson, pointed directly to the electrification of everything. And this is the big one, the insane power demands from all the new AI data centers. We're not talking about a normal business cycle here. This is a fundamental, long-term shift. And look, this isn't just talk and fancy charts. They backed it up with proof that they're getting stuff done. They hit a major first-fire milestone at their Ohio plant. They locked down a new contract over in Ireland. They broke ground on a monster 1.2 gigawatt plant in Texas, and they wrapped up an LNG project. This shows they're actually converting that giant backlog into real-world progress.
Okay, so that's the bull case, and it's a pretty strong one, right? Now let's flip the script and try to understand the market side of this. Why the skepticism? What was really behind that after-hours sell-off?
It really boils down to this one simple and maybe frustrating point. Despite the record profits, the record backlog, the zero debt, the market just could not get past that tiny revenue miss. For a lot of traders, top-line growth is king, and any miss, no matter how small, flashes like a giant red flag. Now, to be fair, you kind of have to understand the business they're in. They're an EPC contractor, which means their revenue is naturally lumpy. It doesn't come in a smooth, predictable line. It comes in big chunks from these massive, long-term projects. The market knows this, but it still gets nervous and watches that conversion from backlog to revenue like a hawk. All right, so there you have it, the bull case, which is all about incredible fundamentals, and the bear case, which is really just hyper-focused on one line item. So where do we come down on this? It's time for our final verdict. Here's how we're thinking about this. It's a pretty straightforward framework. Step 1, you have to acknowledge the elephant in the room, that revenue miss. But step 2, you weigh that against the absolute mountain of positives, that $2 billion high-margin backlog. Step 3, you factor in those huge tailwinds from AI and modernizing the grid. And finally, step 4, you look at a management team that's proven it can execute, all while sitting on a pile of cash with no debt. And when you lay it all out like that, it brings us to our final call. Here at Talk Tickers, we're rating Argan an outperform. Our thesis is pretty simple. We think the market's reaction is short-sighted. It's an overreaction to a minor top-line miss that completely ignores the massive long-term earning power that's locked away in that $2 billion backlog, especially with this AI-driven energy boom that's really just getting started. We think that as that backlog starts turning into recognized revenue, the market is going to have to wake up and reprice this stock.
And as always, a reminder, this is not financial advice.